Today, we're going to interview the president of Secure Retirement, Richard Morey. Richard is going to answer some what I think are very difficult questions, and I'll be interested to see what he has to say. Richard, what is the smart money doing?
Thank you, Jeff. It's great to be here today. The smart money, I believe, is doing what we're doing, which is called hedging. There's many different ways to hedge your risk in an investment portfolio, but only a few of them, and actually we could probably narrow it down to one this year, works in an inflationary environment. The biggest thing that has turned everything on its head is inflation, and inflation leads to all this volatility. It ends up meaning that most of the hedges that used to work may not work and have not been working in an inflationary environment.
As a portfolio manager, how are you constructing portfolios and dealing with inflation today?
It's been very tricky this year. And it's been tricky because, like I said before, inflation has turned everything upside down, and that turned many of the traditional hedges upside down. What do I mean by that? Well, the most common hedge in an investment portfolio is the difference between stocks and bonds. Stocks go up, bonds might go down. Stocks go down, bonds go up. Not this year, obviously. When inflation hits, they both come tumbling down together. So that hedge hasn't worked. Another hedge is gold. Gold's a very famous, longest running hedge in the world. No value this year from gold. I could explain another time why that's not that surprising and why we still think gold on a bit of a longer term, say 2 years from now, probably has great potential. But those aren't working. What other hedges are there? Oh, how about international stocks or bonds? You can cross that off the list. Forget that as any type of hedge. What's that leave us? What we really need is a hedge that's based upon volatility. In other words, a hedge that doesn't need to predict where markets are going exactly, but just profits from volatility. And there is such a hedge. It's called managed futures. Most investors have probably never even heard of it, but it was one of the first hedges, the most common institutional hedge. In other words, this is what the smart money's doing. The big money has a huge amount in these things called managed futures. And the reason is they're designed to profit due to volatility. And it's the only hedge we found in the whole world this year that has performed as a true hedge, meaning it's been going up when stocks and bonds have been going down.
How would you describe managed futures?
The first thing I would say is that from one angle, they're extremely complicated because they're elaborate, quantitative, mathematically based trading programs that can be quite complicated to attempt to understand. But in principle, they're not hard to understand at all. They simply have access to 150 markets around the world. That's stocks and bonds from around the world. That's commodities. That's interest rates. That is gold. That is basically every asset class. They can either buy or sell. And so they can go long or short, everything, anything. That makes it so that they're not worried in the least when one market comes tumbling down. To the contrary, the way they make their money is when markets get volatile.
How do the managed futures actually make money from this volatility?
Good question, Jeff. The way they do it is they're mostly what are called trend following. So what they do is they find one of those asset classes. That's not accurate, actually. They usually invest in dozens and dozens of asset classes at the same time. What they do is they look for the asset classes that are having the most volatility. They get in as early as they can when their algorithms, their mathematical, historically researched trading program says, yes, it's now time to buy this one. So they try to get in very early on one of these trends, and then they ride it until history says time to get out. Now, they don't try to time it. These are not market timing things. They follow the momentum, and then when the momentum starts to break down, they sell that and move to something else. If you look at actual examples, how have they made money this year? Managed futures have had a great year so far. I think they're going to have a greater year the next 12 months. How have they made money? They've made money from the US dollar going up, earlier in the year from commodities going up, from interest rates going up, from bonds going down. That's how they've made money this year. That's probably not how they're making money today.
Right.
Because I know they've exited at least half of those positions. So they follow the trend up, sell, reap the profits, find a new trend that's just starting.
This sounds a whole lot like tactical allocation. Can you explain that, kind of how that correlates and works?
The whole system of the investment industry is trying to talk people into accepting what you get at the start and then never changing it. We think that is a failed and failing approach. We think it's the opposite of how an investor should act. You shouldn't just stick your money, let it ride without looking at the world. The world is rather different today than it was yesterday, 5 years ago, 10 years ago. These are massively, quickly changing times. To just set your portfolio and let it run forever? No. Instead, let me give you an example of how to do tactical allocation. And this is what the managed futures funds do inside. Well, we do it at Secure Retirement in our portfolios also. January 11th, the Treasury bond market started to get hit. So what did we do at Secure Retirement? We sold in our tactical allocation portfolio 100% of our government bonds on January 11th. They're down 40% since I sold them. Actually, they were down 40% when I started to buy back in 3 days ago. So that's called tactical allocation. You leave the market when you've made money, ideally, and before the big losses occur. It's not, I started to say it's not that difficult, but it actually takes a lot of work, which is why most advisors don't do it.
Yeah, I was going to say, Richard, it sounds like long days to me.
These days, I look at our accounts, and if something's not going right, I change the correlations inside very specifically. This week, we lowered the risk level of our portfolios 25% by changing the correlations without changing the expected return. There are ways to manage money that are so much safer, that puts you in the place the market is telling you ought to be.
Yeah, I'm hearing a lot from reading about these investment managers and analysts talking about the old 60-40 portfolio, 60% stocks, 40% bonds, or something like that. I think it's becoming more and more accepted or widely observed that that's not working very well.
No.
Especially what's happened this year. It's just been disastrous.
And the diversification that's supposed to protect you, obviously the bond portion of that 60-40 has let you down big time this year, obviously. And going forward, I don't think it will do quite as bad as it did the first part of this year, the 60-40 portfolio. I think you might have a little while longer to go broke if that's what you want.
Yeah, you always want to put that off as long as you can, right?
Exactly. And that, quite frankly, is how markets unfortunately work in bear markets. It's almost like they're designed to extract the most pain from the most number of investors. The market keeps giving these upswings. Oh, it's going to be okay. And then it comes down again and it goes down further than it did the last time. It's a stair step down. How far? We don't know in advance. What's different at Secure Retirement versus what I hear on the financial media and other advisors saying all day long, every day? They're all hoping that, oh, we're going to have a recession probably next year if we're not already in one. But it probably won't be anything to worry about. This will be if we have a recession, it's probably going to be mild. On TV, they debate how mild it'll be. Well, I would say study history. Find me a recession caused by inflation that was mild. Just study them. Look at them and tell me all the previous recessions in the United States ever caused by inflation, what were those recessions like? Then you will, if you study that, you will see why we are so all in on hedging against that risk, especially when we've learned how to not just protect through the hedging, but actually make money. The worse the market does in the next 12 months, the more we'll probably make.
A lot of people are also always wanting to know any specifics that you have on your mind that you might even like to invest in.
Oh yeah. Basically, there's hedging, which we're doing, which can be quite profitable in difficult times. And as of the last few months, there's something called cash. But not regular cash, not the old cash that earn nothing. 1-year treasuries are paying, I don't know, about 4%. Mm-hmm. You can get 4.5% probably on a 2-year product. Mm-hmm. There are fixed income alternatives now paying 4 to 5%, which isn't bad and is a heck of a lot better than what I expect the average investor is going to experience over the next 12 months. So, I mean, that isn't the type of money we would like to make in this environment because there's so many opportunities to do what we're doing. However, there's nothing wrong with that. If you make 4 or 5% and avoid this risk, we do that.
Fantastic. Yeah. And that makes a lot of sense because, all of us need to have some of our funds in something risk-free.
Yeah.
And the fact that, with these interest rate aggressive hikes that have been going on, that has benefited fixed income. If you want a mortgage, it's not that great, but if you need to invest cash, it's a whole different story today. Yeah.
Oh, we found a 5-year fixed annuity paying over 5%. That's fairly attractive. Personally, I think 3 years from now, you won't be able to get those rates.
The thing is too, for most of us, we haven't had real inflation in 40, 45 years. Yeah. It's been in the back, totally in the back of our minds, on the back burner for a long, long time. And so responding to it, I think there's probably a lot of people in the investment world who never even thought about how to respond to it. And they're hopefully learning now. But it's a lot to deal with. And so
what I've done for 22 years, inflation has been my greatest study in my professional life. For 22 years, I had an inflation protected portfolio in my top left-hand desk drawer for 22 years that I would update yearly. Never came, but I knew the risk, if it ever came, the risk to retired people. Mm-hmm. So that's what I did. And of course, I brought it out at the start of the year. Unfortunately, most of it didn't work because the traditional hedges, only one of them worked. Thank goodness, managed futures did work. However, things are already changing in the markets. Things are changing literally every day now in big ways. And so it's a lot of work. Every single day, I look at everything we own, what it did, how it moved in relationship to each other. I double check the risk level of the portfolios, make sure the number is right on with the risk level. and then see if any of the correlations need to change. Are they working properly? You have to do it every day in this market, I believe, in order to do the job properly. I wonder how many advisors are doing that.
I don't know. It sounds like a lot of work to me.
I know it is, but it's fascinating. And if you know what you're doing, I can see why most people wouldn't do it, because what's a correlation?
Yeah. So one other thought I had, Richard, that people might want to know about the managed futures. What are you buying and how do you buy them? What form do they take?
Yeah. So a great deal of study goes into picking a managed futures fund. You have to study every conceivable thing that is publicly available and some that isn't publicly available that you can get from talking to the managers.
Mm-hmm.
And even then, you don't really know, because they're not going to disclose what's inside those algorithms.
Mm-hmm.
You have to kind of figure it out. They'll tell you the generalities, but to see it working, the only way you can do it is to watch it every day for a long time.
Mm-hmm.
And so that's how you figure out which ones to buy. And then you have to monitor them all the time, because it's all about the correlations between the asset classes. I mean, that's a key part. And I do the same thing they do. I look at how our correlations in the portfolio are doing. And when I see an asset class that needs to be overweighted, if they're not doing it, I replace them. Mm-hmm. Or I add it on my own.
And that's an important thing, Richard, too, for everybody to consider is, what if something isn't working the way you want it to? How do you get out of it? And how do you get something back into it? And the fact is, these funds they're mutual funds. They're liquid every day. You can come in and come out. And
I found a magic button on my computer quite a few years ago. It's called the sell button. If another point about how you can use the managed futures properly, you have to calculate the risk carefully. Okay, so they do careful risk control in each one of the managed futures funds, but the risk level they accept is higher than I want for my retired clients. Mm-hmm. So I manage it, and if one of them gets too volatile or is on the wrong side of the trades, if it goes down more than a certain amount, it's gone, no matter what it is. Mm-hmm. So I control the risk level on the portfolio level, even though every one of our funds is using the same risk control method to control their risk. Right. Makes a lot of sense. Well, this has been fantastic, Richard. Do you have any parting thoughts for us on this? I think the only thing I would say is party on, dudes.